I'm going to give you a brief overview of steel prices, short-term and long-term. Now, let me ask you something. How many people in this room remember, I know Ray remembers, when chain link prices never moved for 20 or 25 years? You remember that, Ray?
Oh, yeah.
Right. In fact, you could buy galvanized chain link fence at one point cheaper than you could buy it 20 years earlier. So steel never moved. It just didn't move. It didn't even drop. In fact, it dropped over a 20-year period. Those days are gone when steel prices were stable, and for decades we hardly had a change in price. And here's some reasons why those days are gone. Current global supply and demand forces for steel have meant that price swings are now more dramatic and frequent. Think about it. Decades of stability, prices never moved, and then came 2004, 2008, and now we're looking at prices in 2011. This is becoming the norm. It's going to be unstable for many, many years. There's no sign of this trend changing anytime soon. Commodity price volatility appears to be a new reality of construction to which the steel industry will need to adjust. The last 6 weeks of 2010 demonstrated this volatility. Beginning in mid-November, carbon steel pricing shot up 27% in a 5-week period. Scrap prices also shot up. If you look at the sheet I handed to you, there's a section right here in scrap prices. Total change from January 2009 to current is approximately 72%. Now, for whatever reason, rebar producing steel mills seem to lead the charge on pricing. So when this all happened, this large increase occurred in a 5-week period, they started scrambling. And the reason they started to scramble and what was causing all the problems were their input costs. Now, the rising price of input cost create what is called a cost push inflation. What's that mean? It's very simple. This is what it means. Your input cost, your iron ore, your scrap steel, your coke, your electricity, your natural gas, all the input costs that go into the manufacture of steel are going up. That drives the price of steel up. A lot of people will say, hey Mike, why is steel going up? We're really not that busy. And everybody thinks of supply and demand as being the main reason why the steel's going up. Well, the main reason is what they call cost push inflation. The cost, the input costs are driving the price of steel up. In the end, when all these increases occurred in that short period, the mills raised their prices 25 to 30% over this incredible short period of 5 weeks. Now, trying to bet on the exact steel price, even a month out, will be an extremely risky business. No one really knows. Looking forward, this volatility will continue. It's not going to end. The longer-term trend in the steel industry is rising steel prices. There are a number of reasons for the assessment of rising steel prices, but amongst the most, there's 2 major reasons that are driving the price of steel up. Number 1, demand for commodities will remain strong as long as the world's major developing economies can continue their incredible pace of economic growth. Leading the pack in this pace of economic growth are what they call the BRIC countries, B-R-I-C, Brazil, Russia, India, and China. They're leading the charge. There is little to suggest a major slowdown in these economies. And their strength and resilience has been demonstrated by their ability to grow strongly despite years of weakness in the European and North American economies. Second, the number 2 reason that steel is going to continue to rise is steel demand will pick up in the U.S. in 2011. There are signs of improvement in both the automobile and non-residential construction sectors. After a near collapse in 2009, the U.S. auto sector is bullish again. They are predicting that car production could, and I mean could, pick up by 50% in the coming years as global demand for autos increases. This will positively, the auto demand will positively impact the U.S. steel industry, as the auto sector typically uses 20% of the U.S. steel production supply is consumed by the U.S. auto industry. In non-residential construction, and I think I sent Ralph an email and a few other people, the U.S. Architecture Billings Index, a leading indicator of non-residential construction activity, reached its highest levels since 2007. So basically speaking, you got 2 forces here. On the outside, you have all these developing economies, Brazil, Russia, India, China, putting all these pressures on commodities, iron ore, scrap iron, etc., etc. And at the same time, you have the U.S. auto industry and the non-residential construction sectors starting to perk up and putting pressure on your domestic supply. So these factors are all going to come into play, and demand is going to continue to rise, prices will fall. Also, there are a number of other indicators that point to a slow but real recovery in U.S. construction activity in 2011. Now, because of all these reasons, you can expect more volatility, but also expect to see steel prices in 2011 and onward keep going up. Now, having said that, we can make a case for falling prices, which there is. Some say prices will fall right after there's a run-up and after the restocking occurs, going through the first quarter into the second quarter. If you look at the sheet I handed out, and right where it says steel market news, go down to the second line, and you'll see where it states, not the second line, I'm sorry, to the bottom, 4th line up. Service center shipments are up, which has caused service centers to hedge more buys and to get inventory levels up. So what's happening is, there's not much material on the ground, there's suddenly demand, and everybody's restocking. So the question becomes, how long will restocking last? Will prices continue to rise? Well, they could start to fall after restocking. It's a possibility. Also, there's 3 other factors that could drive price declines. Number 1, and this is an interesting factor, any or new additional sovereign debt crisis could negatively impact GDP. Now, a sovereign debt crisis is not a personal, individual debt crisis or a corporation debt crisis. It's a country's debt crisis. The United States could have a debt crisis, and this could negatively impact GDP in 2011. Second, auto sales could drop below 2010 levels, lower construction and residential, lower commercial and residential construction. And thirdly, raw materials dropping. I don't really see raw materials dropping. It's highly unlikely, but there's always a probability of it occurring. So, in my opinion, chances of prices rising, especially in the long term, and not going down in the long term, are greater. With an annual U.S. GDP of 2.5%, historically speaking, steel demand grows. In 2010, U.S. steel production was at 88.5 million metric tons. The U.S. steel market performed at that level under its historical averages. The averages for the U.S. steel market are between 90 and 102 million metric tons, with most years in the mid to upper 90s. So in conclusion, I see steel prices continuing to rise into the second quarter, holding until demand softens in the third quarter as people begin to reduce their inventory, building it up in preparation for season end. So basically speaking, once we get to the third quarter, it'll slow down because people will start cutting down on their inventories as season ends. Also, another factor to remember in the steel industry is that there's less capacity now than there was in 2008. Manufacturers downsized and they reduced costs. So their ability to recover and recoup and fulfill the demands in the marketplace, they're going to struggle. They don't have the capacity. They're at 70% capacity. States are right here in the market news. So that's going to be a problem. So basically speaking, if you're a fence contractor, based on the information that I have gathered together, I would recommend that you order enough material in steel to take you well into the third quarter. Especially with the size of the announced price increases, I can't think of a valid reason not to order. Ladies and gentlemen, thank you. Material will take me into the third quarter, to be honest with you. I mean, with these rate increases, and if you have excess cash, your money's in the bank, what do you get? You get nothing. You're better to take that money that you have, even if you're borrowing. What are you borrowing at? 3, 4, 5%? With 15, 20, 30% increases? Buy that material. It's not, you know, in the short term, everything does this in the short term. Goes up, goes down. But if you take it from point A and you start to draw a straight line and chart it, you're going to see there's a steady rise. And it's not going to end.
From